Hi there traders, this is Steve Miley, the market chartist on behalf of FxExplained, and this is our regular weekly MacroWatch update. A look at the geopolitical, macroeconomic and data events that have impacted markets over the past week, and then looking out into the week commencing the 16th of March 2020. Well, capitulation pressures have intensified undoubtedly across financial markets, and the spread of the coronavirus, particularly in Europe, has exacerbated that panic and that capitulation. Having already had shutdowns and lockdowns in Italy through last weekend, we've now seen Spain also go into lockdown, and many European nations now closing schools, banning large public gatherings including sporting events, whilst further containment measures are expected across Europe into this week. Furthermore, in addition to this spread in Europe, the US has seen a ban on travellers from Europe into the US and now from also the UK, with President Trump declaring a state of emergency on Friday. Again, further containment measures are anticipated in the United States. Panic buying has broadened globally. From previously just the buying of hand sanitizer, disinfectant and toilet rolls, with now broad-based panic buying echoing intensifying fears amongst the general public. The financial authorities have attempted further measures to intervene to stabilise financial markets, with equity markets in freefall since late February. We'd already had the Reserve Bank of Australia, the Bank of Canada and also the US Federal Reserve cut interest rates, with the Bank of England also producing an intermeeting interest rate cut last week on Wednesday. This interest rate cut from the Bank of England was somewhat unexpected, but was timed to coincide with the UK budget, which saw an attempt to provide a fiscal boost to the economy with modest tax cuts but a significant increase in government spending. Last Thursday, the European Central Bank did not cut interest rates, which are already sub-zero, but did announce measures to support bank lending and also increased its asset purchase program. Whilst on Thursday, the Federal Reserve also announced 1.5 trillion in capital injections via the repo market to try to calm Treasury bill liquidity issues in an attempt to also improve economic activity given the risks from the coronavirus. Although stock markets did stage a strong rebound on Friday, this was only after a devastating plunge earlier in the week, with the market free falling since late February. Ongoing fears regarding the global coronavirus spread alongside the potential fallout from liquidity risk in the financial system have kept markets extremely nervous. To highlight the severity of the recent moves and the volatility, the S&P 500 had its largest percentage down day on Thursday, minus 9.5% since the 1987 Black Monday crash. But then it managed its best up day on Friday, up 9.3% since October 2008, with the market not actually posting consecutive back-to-back 9% daily moves like this since October 1929. Turning to the safe havens, global bond markets have started to sell off from record low yields, partially due to fiscal stimulus hopes, but also likely due to investors selling the good to pay for the bad, selling the successful trades to pay for the more unsuccessful loss-making trades. Gold has also sold off in here, partially no doubt due to the same selling the good to pay for the bad reason, but also likely due to the surge into the second half of last week in the US dollar. This takes us to the forex side, where the US dollar has rejected its previous position as the ugly sister across major currencies, having sold off aggressively the prior week, to surge over the past week into the end of the week, with US dollar versus Japanese yen back above 107. And in fact, the risk currencies, the Australian dollar, New Zealand dollar, Canadian dollar, are all selling off aggressively again in here, with the Australian dollar now its lowest since 2008, approaching an even deeper low in here, potentially through 60 in here, will point to its lowest since 2002-2003. Oil has stayed low despite a slight rebound, but staying low after that 25% fall that we saw after the price war broke out between Russia and Saudi Arabia last weekend, which has seen oil stage a slight rebound but still look very vulnerable to potential further downsides. Let's now take a look at the week ahead, week commencing the 16th of March. Well, the data regarding the European and US spread of the deaths from the coronavirus will remain in focus, alongside the increasingly stringent containment policies put in place by national governments. The functioning of the liquidity and credit markets is also of particular concern, and we will need to monitor those going into this week. Let's turn now to the central banks. Wednesday critically sees the Fed and their interest rate decision, with futures markets pricing in between a 75 basis point and 1% rate cut, an additional cut from the Fed since their previous intermeeting cut just in the last week or so. On Thursday, we get the Bank of Japan, where we do see some monetary policy stimulus, but unlikely to see a rate cut. Thursday sees the SNB, the Swiss National Bank, and then on Friday we get the People's Bank of China. Also, we're going to need to continue to watch the oil price, as it's going to be an important factor to monitor going forward, given the current price war between Saudi Arabia and Russia. Let's now look at what we've got coming up this week on the data front, with the data not really that significant, but we're certainly looking at those central bank meetings. Chinese retail sales and industrial production to kick off the week. We have the RBA meeting minutes on Tuesday, UK employment report and the German ZEW survey alongside retail sales. Then it gets more interesting as we turn to the central banks. We have the Fed, the FOMC on Wednesday, Australian employment report, but then the BOJ and the SNB both on Thursday, and then the PBOC interest rate decision on Friday. I'm going to wish you all guys out there a great trading week. Be careful out there, and please do join us again next week for our regular Macro Watch. Don't forget to follow us on our YouTube channel. Have a great trading week. So traders, don't forget to catch us on the next FX Explained Macro Watch and all the great content on fxexplained.co.uk.